Welcome everyone to our carbon equity co-investment webinar. Really nice to have you here. Unfortunately, Wiebe fell ill today, so we got someone even better. We got Caro from New York calling in. I think you'll see her on the screen when she speaks, or you'll see her in gallery mode already. So today we're going to dive into the carbon equity co-investment fund. And during this webinar, we'll tell you about why we launched it, why now is the time to have this in our portfolio, and also how it complements to our existing carbon equity funds. So we'll tell you about the strategy and the portfolio construction of our co-investment fund. And we will also explain our focus and just the opportunity that we see around making these late stage investments into climate tech and energy transition co-investments. So what we thought would be most beneficial and most interesting is to just answer questions that we most often receive from investors in one-on-one conversations. And we focus these around 5 chapters in total. And they will especially be focused around target returns, access, and risk. And for this session, I'll guide the conversation and I'll ask Caro the questions. We will also focus on questions that are coming in via the chat, but also that you previously sent in via the register form. So we'll cover all of that as well. And during Caro's answers, during some of them, I will also share some slides that help support the narrative. So it might go on and off, just to show you a bit about what we're normally also showing when we pitch the co-investment fund and when we tell you more about the co-investment fund. So if you have any questions, please post them in the chat and we'll answer them at the end. Then let's start with our personal introductions. Caro, do you want to take it away?
Happy to. Hi, everyone. Nice to be here with you today. I'm Carolina. I've been with Carbon Equity for almost 5 years now. So I joined the firm quite early on in the journey as actually the first employee in the investment team. My background is in finance. Started my career advising on M&A transactions in the tech world before deciding to dedicate myself fully to impact investing and joining Carbon Equity. As Liz mentioned, I am based in New York as of almost 2 months ago. We decided to relocate me here to cover the US market a bit better. As with our growing fund relationships and co-investments, it made sense to have some boots on the ground finally.
Yeah. I'm Liz Engelbert. I started working for Carbon Equity 2.5 years ago and in the team for mostly professional investors. So we have a group professional investors and private investors, and I mostly focus on family offices investing with us. Before this, I was for 3 years in one of the Netherlands' biggest climate tech scale-ups, also focusing on investor relation and fundraising. And before that, did 2 masters in a combination of finance and business and sustainability. Here, those 2 worlds really come together greatly, and happy to be able to devote my time every day to this. Okay, let's dive into the co-investment fund. The first chapter is about the kind of the macro environment and timing. So why now? And for this to be a bit of an interactive webinar, we have some questions that we boiled down that we think are most important. And then from there, you can also ask additional questions. So, Caro, after deploying across almost 30 climate funds and like 275 companies, what makes this the right time to really launch a dedicated co-investment fund?
Yeah, well, I think you almost answered it yourself. But yeah, to give some of the story, we of course started Carbon Equity about 5 years ago now with the fund of funds investment strategy. And by now we are one of the most active climate and energy transition fund investors globally, if not the most active. And that has built us a portfolio of yeah, you said it, 275, I guess now is the number, indirect investments in climate tech companies. And even beyond that, kind of our universe of climate tech companies, if you consider the funds that were deployed by our managers before we invested. That universe is, I would say, closer to the 600 or 700 even of underlying companies. And we realized that we were sitting on actually quite a bit of data because every quarter, of course, we get a quarterly report from each of the 30 plus funds we've invested with. We also have regular catch-up calls with our fund managers, and we just hear which companies in their portfolio they seem to be very excited about that are having a lot of traction. And increasingly, we got invited to follow on or invest alongside our GPs in these rounds. But at the beginning of carbon equity, we actually didn't have the flexibility to do these co-investments. So having seen that opportunity, we actually already a bit over 2 years ago added that flexibility to do co-investments within the fund of fund program. And that's what we've been doing now for 2 years. So we did 8 co-investments already from the fund of funds. And then at some point, it just made sense to have this dedicated fund to have actually even more firepower to be able to deploy into these companies that we're excited about.
And can you then maybe illustrate for the audience what's the difference between a co-investment fund and a direct fund?
Yeah, it's a great question. I think really, again, the difference is kind of in the name, right? So we're really a co-investor. That means that we are not a lead investor in a round, which is something that a typical growth equity investor, they don't have they have an undefined universe of companies that they have to go find. They have to do the diligence from scratch, set the valuation, the terms, and then start building a syndicate, which is more the time where we come in. We have a more defined universe of companies. So it's all the companies that our funds have invested in funds that we're either part of or before that. And we get a bit of a kickstart on the diligence because we've been tracking the company already for years. Our GPs are willing to share their memos, their model, their diligence with us. And we're not setting terms. We are assessing the terms to see if we think the valuation is fair and attractive. But we are really co-investing and being more of a follower investor in these rounds. So that's a bit the difference from a strategy perspective versus a direct fund. And of course, that also leads to a difference in the terms. A typical direct growth equity fund would charge usually 2% management fee, 20% carry. Our fund charges half of that to also reflect that we piggyback a bit or leverage the work that our funds do.
Yeah, right. And can you tell a bit more about the team that does it? So who is behind this? We have, of course, this slide with your team. On the left of it, of the dotted line is the investment team. Can you tell a bit more about the experience and the people you work with every day?
For sure. So yes, indeed, the 8 people on the left of the dotted line is our full-time investment team. The 4 people on the top of that bit is our IC members. And so Viwe Visser, who was supposed to be here for the webinar today, he leads our team. He's our chief investment officer. His career started at JP Morgan, where he was in the investment banking team for 6 years. And then he was, before Carbon Equity, at Alpinvest, which is the fund investment arm of the Carlyle Group. There, he focused actually primarily on secondary investments, which is when you're buying a portfolio of companies or sometimes even a single company from an existing investor. So you're trading with an existing investors. And in that process, he actually had to underwrite companies from scratch. So very similar to direct investing. Then I'll walk through the other IC members so you get a sense of kind of who's behind also the decisions. Lara Cole is one of the co-founders of Carbon Equity. She has been a venture capitalist before. She was one of the founding members of Philips Ventures, the corporate venturing arm of the corporate Philips. And there she did both direct investing and fund investments. Then we have Lisa, who came from McKinsey. She brings more the energy transition research and impact angle. She led a lot of their work around how to decarbonize industry and their client work on the energy transition. And then we have Bas, who actually worked with Vive for quite a long time, about 7 years at Alpinvest. So they had that working relationship before. And he joined us early on at Carbon Equity about 4 years ago. Well, myself, I've talked about, and then Eva, Itz, and Sam bring really very interesting technical backgrounds in engineering, chemistry, food science, and together with the eight of us, we run our diligence processes. And of course, we get support from the broader carbon equity platform where you see um, some of the other people here on the screen. So this team has been working together, at least like the core team, since the inception of carbon equity. We haven't had any people leaving, so we're quite used to working together, and we've been fully focused on the climate and energy space ever since. So that's given us a lot of time to build up our specialist knowledge.
And what does then a typical process for a co-investment look like?
Yeah, great question. They vary, but it can be a process can last anywhere from, let's say, 3 weeks in a very fast scenario to 2 months. And again, we know these companies before we have the co-investment opportunity live. So we've had usually through quarterly reports and through catch-ups some information of the company, but then at some point the round is actually live, and then you start your diligence process, and that can take usually 1 or 2 months. And we would form a deal team where usually Wiebe or Bas would be the formal deal lead, and there would be 1 or 2 other people working on that team, and then building really our own diligence. So we leverage the diligence materials from our relationship GPs, but we really supplement that with our own analysis, our own reference calls, our own financial modeling to make a investment proposal for our IC.
Okay, and I often get the question from our customers and leads why it's important that the same team focuses both on funds and on co-investments, because up until now we have done some co-investments, but mostly fund due diligence. So yeah, why is that important, or why are we structured that way?
Yeah, great question. I think you see it sometimes with bigger platforms that these tend to be different teams. In our case, given we're such a specialist investment firm, it's beneficial to us that we keep it within one team for different reasons. First, the investment team has the fund relationships. We do the catch-ups. We go to the AGMs, the annual shareholder meetings, where also a lot of the portfolio companies are. So we are the ones that are kind of hearing the updates, seeing what companies have traction. We're also the team that is tracking all the performance coming out of the funds every quarter. So from a relationship perspective, we are kind of the ones getting the information and having that step ahead in knowing the companies a little bit. So by the time that the co-investment opportunity comes, we're ready to go. And then the second reason would go more towards the specialist knowledge kind of points, because when we do our diligence on a fund, given we are such a specialist investment firm, we go a bit deeper probably than a generalist LP into the technologies that a fund is investing in, whether we think those are important for the energy transition, but also we try to really test a fund on whether they understand the sectors that they're investing in. So that's given us over the years kind of foundational base of knowledge around the sectors that we look at, where it be batteries or fuels or all the different kind of bits of the climate space, because it's more of a defined thematic focus that we have. It really helps us in both strategies.
Yeah, so it's actually more efficient and brings us more value with the same people that have that knowledge already from the funds.
Yeah.
Okay, and maybe to conclude this chapter, because it's about why now, we focused mainly on our internal why now, why it's a good moment for carbon equity to start with this. But why is it interesting to start with this from a like macro perspective, looking at the world outside of us?
Yeah, sure. So I think couple reasons. What is interesting with our co-investment strategy is we're really focused on that growth equity stage where companies are starting to properly scale commercially. And we've seen throughout the last couple of years that the growth equity stage in the energy transition remains a bottleneck or remains actually relatively underfunded, which creates an opportunity, which is if you have a properly sized fund that can lead a growth equity round in the energy transition with, let's say, 20 to 50 million check. There's actually not so many players that can do that, that have both the knowledge and the fund to be able to do that. And that means that you can get quite interesting terms relative sometimes even to when earlier stage investors came in. Um, at the time where we are now, I think there was a lot of investment in our sector in the early stage in 2021, around that time. That means that those companies have by now been able to mature and reach the growth equity stage. But actually, also, there was a lot of elevated valuations at that time. So if you are in this growth equity position where you have some leverage, you can again reprice and enter at more attractive valuations. I would, that's kind of the context for the stage that we chose to focus on. And then from a thematic perspective, we get this question a lot around like, you know, I see things in the news around perhaps less support for climate. How do you see that? And I think what's important to emphasize is that climate is not really a theme. It's an outcome. There's different companies that do make a product that in the end has an outcome in the world, and that is climate impact. But from a thematic perspective, a lot of the things that you're seeing in the news nowadays, for example, this whole movement towards strategic independence and onshoring manufacturing supply chains is very related to a lot of the companies that we've been investing on for the last 5 years. One good example would be for the rare earth element supply chain. So, or in general, the metal supply chain. There's a lot of critical metals that we need for the energy transition that we also need for other applications. A critical metal could be like copper, or the rare earths are more specific, but these are things that you need a lot in motors for EVs, but also to build, for example, turbines, etc. This value chain has been in China for the last decades, and with the geopolitical context that's happening right now, both Europe and North America have really made an effort to onshore these supply chains, and that has led to a lot of traction for our portfolio companies in that sector, for example. Another really big tailwind nowadays is the whole wave of AI and data centers. Why? Because with the big uptick in the build out of data centers that we expect primarily in the US, a lot of electricity is needed to supply those data centers. And the most important thing for them is speed to power. So they're actually a bit less sensitive to the price of the power, because relative to the price of the GPUs, it's not so much, but they're very sensitive to speed. And the fastest thing you can do right now is solar and batteries, because natural gas supply chains are a bit backlogged, if you know that. So we've seen for our energy generation companies in the portfolio, that could be in geothermal, nuclear, biomass to electricity. We've again seen a lot of traction coming out of that wave of AI. And in general, beyond kind of the data center, we are seeing a move towards the electrification of everything as we continue to electrify vehicles or home heating, because it becomes economically cheaper to do it. We see that a lot of our companies continue to get traction just because of the fundamental benefits of renewables and storage being more efficient.
Right. It's really interesting what you say, that climate is not just one vertical. It's really broader than that, going through society as a whole. Maybe that's a good moment to also bring us to the portfolio construction of the co-investment funds. So maybe it helps to put this slide on the screen. Can you maybe share first how many co-investments we aim to do, what our ticket size will be, but then also how is the portfolio constructed, and just walk us through these pie charts?
Yes, sure. So we are aiming to make 12 to 15 different company investments with initial check sizes of 2 to 5 million, likely more 3 to 5 million, based on when the fundraise is going right now. And alongside that, we will keep some reserves, so around 30% reserves, because for a lot of our companies, we don't expect there to be a next round, but for some of them, we do expect there to be one more funding round. So we keep a bit of reserves to be able to participate there and defend our ownership stake. In terms of the strategy, so yes, you can see it in the pie charts here. From a stage perspective, we're looking at Series B plus rounds in general. We tend to call Series B rounds early growth, because that's usually the companies that are going from that stage of doing 5 to 10 million in revenues to 10 to 20 to 50. Whereas we also look at a lot of later stage companies that we call late growth, that are beyond that stage, that are really already at the 20 million plus, going to the 100. So all Series B plus, but a bit different in terms of their commercial maturity, perhaps. From a geographical perspective, we expect half or a bit more than half of the portfolio to be deployed in the US, with the remainder big chunk in Europe. And then we leave a little bit of flexibility to do an investment outside of that geography. Uh, we don't, so our main focus at Carbon Equity has always been Europe and North America, but we increasingly see opportunities, for example, in India or LATAM. And actually, we made our first co-investment in LATAM last year that I'm happy to talk about. So that's more opportunistic in case that we would find a deal outside of our core geographies. And then in terms of the types of technologies you should think about, it says here on the slide that 75% is hardware. But before you think that we're going to go funding cement or steel plants, what I want to emphasize here is that there's really very limited opportunities in a climate software only strategy. Like climate SaaS is not really a thing. There's usually has to be a hardware component, which could be quite minimal, could be just a sensor, or for example, like a smaller robot technology that applies a chemical. There's different, I would say, different spectrum of how hardware intensive a company can be, from really going out to building their own manufacturing plants, which is less what we're focused on, versus a more scalable, more capital efficient hardware technology that tends to combine actually both hardware and software. We'll go, I think, through some examples of the companies we've invested in to give you a flavor of what we mean by that. But I would say in general, in the energy transition, you tend to need to control some end assets to have an impact or to have a change. So that's why most of our investments will have some hardware components.
And within which sectors do we really want to invest, or do we really want to be at?
Yeah, good question. So it's really quite broad, but I would start with the first pillar we see a lot of opportunity is in general electrification of everything, and that is displacing something that is currently fossil based with a more efficient, usually cheaper electrified process. A good example there could be electrifying transportation. So I think we will talk about our first investment in a company called Harbinger later in the webinar, but basically they're replacing diesel or gas-powered vehicles, specifically medium-duty trucks, with electric trucks, and they're able to reach price parity and actually have a lower total cost of ownership. So that category of electrification would generally be opportunities where it's become economically sensible to move to electrified options. Then we also see a lot of opportunities around energy efficiency, which could be something like efficiency within a home. We've made an investment in a company called Luxwell that does a better insulation technology in the form of vacuum insulated windows. So essentially a double pane window where there's a vacuum in the middle instead of a gas. And that makes the building itself much more energy efficient. That could be an example of a hardware application in energy efficiency. But you could also think of, for example, a software company that controls the electrical grid to create more efficiencies of when demand and supply needs to be balanced in the grid. That could be another application. And then we see some other opportunities around what I mentioned with reshoring local supply chains in the, for example, rare earth value chain, or increasing infrastructure resilience by, for example, detecting climate risks better so that it doesn't create power outages, or detecting wildfires to prevent losses for insurance companies. There's a lot of different end applications. I think if you guys are interested, we will share our presentation, which has a much more thorough breakdown of all the sectors we're looking at.
And one question I most often get within this slide is why roughly 60% of the portfolio is expected to be deployed in the US, and then also with the man behind the Oval Office desk in your head right now.
Yeah, that's a great question. I think for a lot of people, it really doesn't make sense why the US is such a big part of that pie chart. I think the short answer is that the US is a way deeper growth equity market in general compared to Europe. There is unfortunately a lack of growth equity capital in Europe. There's only a couple of funds that have raised, let's say, 500 million plus funds in Europe, whereas in the US, there's dozens that can really lead these rounds. So that's one reason, more from the investor perspective. The other reason I would say is more actually historical. So the US has had a longer history of investing in clean tech and in deep tech going back decades. Some of you may have heard of the wave of clean tech 1.0 in the early 2000s, which was largely there were a lot of companies that didn't make it there, with a few success cases like Tesla and Nest. But what that wave led to was a lot of founders that were in those initial solar, for example, companies that then went on to found companies. You have the Tesla mafia of founders, the SpaceX mafia. So there's just a lot of more, entrepreneurial, I guess, track record in this space in the US. Whereas in Europe, I think that that wave only started really probably 5, 6 years ago. So the companies tend to be less mature. And therefore, we see more opportunities in our stage in the US.
And of course, the current wind the current political wind that's blowing is only 4 years max, so it will change over the lifetime of the entire fund anyway, right?
Sure. I think we always have to underwrite to 5+ year cycles. So we have to believe that a company has the fundamentals to do well regardless of a political climate. We're very focused on what value proposition a company is delivering at what unit economics. And I would argue that actually investing under this administration makes you more rigorous around really focusing on whether companies make economical sense on their own. And then any kind of political upside is beyond that. But we're trying to back companies that can succeed regardless of who is in the White House.
Right. Okay, talking about rigorous selection, can you maybe take us through what the selection criteria are for this fund and how you select co-investments?
Yes, and thank you for putting them up on the screen as well. But yeah, these 5 criteria tend to guide our decision making. It's actually, we have almost like a stoplight system at the first screening with all of these criteria. First and foremost is, of course, the return outlook. We have to believe that within an average holding period of about 5 years, we have a solid return outlook towards a 3x. And I think I'll speak a bit later about how we do our underwriting, but usually we tend to just focus on the core business of a company, so not additional products, not additional markets that a company could target, but really just what they're doing today. Do we believe with a conservative growth outlook that that company will scale to a point where they can exit at a valuation that gives us a 3x return? That's our base case. And then again, anything that they can do on top of that, any additional products or markets would be just upside to that base case. That's really the first thing. In terms of commercial traction, we're looking for a company that has multiple commercial clients, that is really out of the pilot and testing phase. On average, I think the average company we've invested in is doing around 20 million euros in revenues, with positive gross margins and an outlook to EBITDA profitability in the coming couple of years. That's kind of the average profile. There will be some cases where we take a little bit more risk for a higher return in a company that's maybe more on the 5 million range. And there will also be cases where we come into a company that is already in the 100 million plus revenue range, where perhaps we're underwriting more towards a 2x. So it's a range, but generally that's the profile of companies we've been looking at. Obviously, that tends to mean that with that commercial profile, your technology has been proven in an operational environment. But we really do focus a lot of our diligence and questions around whether there is no outstanding technical risk in the product, that it has really been used by the customer in the field for a long period of time, and that the customer feedback has been positive on the product. Of course, carbon equity, we have a climate focus in what we do. We assess every technology using our own framework that I'm happy to go into to determine whether we believe they have a substantial impact on climate mitigation or climate adaptation goals that could mean, for example, forecasting the CO2 savings that we expect from the company and assessing for ourselves whether that's a meaningful number. And lastly, we do focus quite a bit as well on the deal dynamics. And what we mean by that is a couple of things. One is, who is the lead investor? Given that we as carbon equity won't be in the position to lead rounds and set terms, we have to assess whether we are aligned with that investment firm that has set the terms. Usually we like to see that it is a external financial investor. So that means that they were not investors in the company before, and that they're really underwriting this round as the initial investment where they also expect to make the return. And we look for alignment with our relationship GP as well. Usually our relationship GP has been an investor already, but we like to see that they continue to follow on in the company, that they really double down and they have high conviction in the company.
And so far, 8 co-investments have really made it through this selection. We're about to zoom in on one of them, but out of how many that have crossed your desk, have come this channeling of 8 in the end?
That's a great question. So I think out of our universe of probably around 700 companies right now, I would guess somewhere between 150 and 200 have really come across our desk. And again, to put this in context, like you might hear from VC funds that they look at thousands of companies per year, and so that number might sound lower. But what you should remember is that our universe is already more narrowly defined because the companies have been sort of pre-diligence by our relationship GPs. So, but to give you a sense, I guess that would be like around the 4 to 5% range of what we've looked at. So we do decline a lot.
Yeah. All right, then can you take us through the first investment of the fund, Harbinger, which looks
Yes.
like this?
Nice, very cool. Yes, happy to. So Harbinger is a company based out of California, and they make the stripped chassis. So if you're looking at a truck right now on your screen, the main product that Harbinger is really building is the bottom of that truck. So it's the part of the truck where the powertrain and the battery in this case would go. So they manufacture that, and then they can sell that to any kind of company that uses a truck. But then you would need to put the box on top of that chassis, if that makes sense. That's how kind of the trucking industry is structured. What Harbinger has been able to do is they've created a vertically integrated company. That means they're building most of the components in-house. So they're building their own battery packs, not battery cells, but the battery packs, their own power units and drivetrain, and all of the architecture to build that. And that means that they can reduce all of the intermediaries in the supply chain and create a more cost-efficient product. There's been a lot of companies that have tried to build electric trucks, but then they would usually use off-the-shelf components. And then every off-the-shelf component you use has a little bit of margin from every supplier, and you end up with a very expensive electric vehicle. So Harbinger took the approach, kind of like Tesla did, of re-engineering everything from scratch. And therefore, they are today already cheaper than a diesel truck alternative and very close to price parity with a gasoline car. Why we were excited about Harbinger is it's a 14 billion market to sell a chassis. And actually, when we were looking at the company, one of the main competitors in the market that has a substantial market share was actually exiting the market. So it created a bit of a gap for Harbinger to step in, and they've quickly displaced even a lot of as I mentioned, ICE or internal combustion engine competitors. Then we came into the co-investment fund in the Series C round that was led by Capricorn and Tiger Global, which are two very large financial investors, as well as FedEx. And FedEx is a company I'm sure you've all heard about, a big global delivery company who joined Harbinger as an investor, but also put in a substantial purchase order to buy their trucks. FedEx has very publicly said that they want to transition their entire fleet to electric vehicles. And at the moment, Harbinger is their primary supplier for electric vehicles. So there's a big opportunity ahead with them. And they also have other investors in the board, for example, a company called Tor, which is the biggest manufacturer of RVs, recreational vehicles in the US. They're also an investor and a large purchaser of these trucks. And from an impact perspective, the medium duty segment of trucking is an area where very little progress towards electrification has been made. When we looked at the company, I think almost 80% of trucks run on diesel and almost 20% run on gasoline. So there's only a couple percentage points of EV market adoption. So a company like Harbinger that builds economically competitive product can make a lot of impact in displacing those.
Have you already seen the electrified FedEx trucks drive past your house or not yet?
Actually, like, I don't think so. I've realized now living in the US for a bit that there's so many of these like medium duty trucks always on the street. There's less rules about when trucks can go into cities, so they're everywhere. And I've seen so many FedEx trucks, but I always look at what brand is on the chassis, and I don't think I've seen a Harbinger one yet, but I'm very excited to see one soon.
Waiting for it, waiting for that day. Okay, let's move on to the next chapter, which is about deal flow and access, which I often get quite some questions about because we're, of course, a co-investor. So, can you maybe touch upon how active we are in sourcing opportunities?
Yeah, for sure. So there's, I think, a couple ways that we source opportunities. One is more like the structural ways that we get opportunities via the relationship GPs. So, for example, during our diligence process, when we're first investing into the fund, we will negotiate specific rights in our side letter agreements with them. And that can include that they have to present X number of co-investments to us every quarter. So for a few relationships, we have that as a investor right in the fund. Besides the legal right, let's say, we just generally have quarterly calls with most of our relationship GPs. We attend their annual meetings, and that's also how we get news of which companies are raising and which companies are excited about. Beyond that, more top-down approach through the GPs, we also have our own database of every company that's in our co-investment universe, which is a list that we regularly go through to try to not miss any important rounds in our universe. We update that database every quarter with the financial performance we get from the funds, but we also complement it with external sources, for example, like Crunchbase, to be on top of every funding round as it happens. And then if there's a company that we, becomes more interesting, either because they've raised a next funding round or because we've heard a lot about them in the news, then we will proactively reach out to those companies to start building a relationship with their founders and management teams.
Okay, and maybe one of the more harder questions. What if a company has a really hot round, everybody wants to get in? Why would one of the managers that we work with give us allocation then in one of their really competitive rounds?
Yeah, good question. I think there's I will split that answer into like there's benefits to the fund of us coming in and there's benefits to the company. So to the fund, there's a lot of LPs that say that they want to do co-investments. That's what we hear from the funds, but actually not a lot of them can move fast enough because when you have a very hot competitive round, it usually closes in 2, 3 weeks. And then if you're a large pension fund or insurance company, it can be tough to get through your compliance and like big processes during that time period. And we are a lean organization that can run a very swift process. So it's actually not so common that you can run a process in the time that we can. And then also with the check sizes that we have, we can be quite a meaningful follower to fill around.
With the what?
The other, sorry,
With what did you say?
with our check sizes.
Oh,
So
check.
we're
Yeah.
in that sweet spot where we're not really like competitive to a direct fund that will write a 10, 20 million check. But we're meaningful enough that that if we can run a process in a couple of weeks, we can really make a difference to the rounds anyway. And then a couple other things that we can bring as a benefit to the GP is in some cases what we've done is we've allowed the GP, for example, to vote on our behalf in the board meetings, not for exit decisions, but for any other things that require a vote at the board. And that means that the GP actually gets more influence and control of decisions, which they tend to like. So that's a reason that they also like to let us into the round. And then there's more on a case-by-case basis what we could bring to a company directly. So carbon equity through the last 5 years, we've built quite a big investor community of thousands of investors through our platform, and also a rather big following as well. And that usually means that there's someone in our network that could be relevant. For example, for the company Luxwell that I mentioned earlier that does the installation for buildings, we had a couple of real estate developers that are investors through carbon equity, and then we can link them to them. For another one of our companies, Aerones, that does, they produce robots that can repair wind turbines. It was actually very beneficial to them that we have a infrastructure fund of fund strategy as well, where we have a lot of relationships with infrastructure investors and infrastructure developers, and we've been able to link them to several potential new clients. So depending on what the company does, there tends to be an angle where our network can be helpful, and that's also a reason that they give us access to the round.
And do you also keep a list or in the database somewhere where you know, okay, these companies are my favorite. If they are going to raise, I want to be there. Or how do you keep track of those?
For sure, we literally have a flag. So our database is in a system called Airtable, where we have all the companies that we have indirect exposure to, and then our team will go through every quarterly report, and then if there's a very exciting update, we will make a flag in the system to kind of bump them up in our pipeline, and then we will go through our pipeline every month with a team, and then proactively reach out to all those companies that we flagged.
Right. Okay, understood. Maybe looking at the time, let's go to one of the last chapters, which is about underwriting and returns. If we're diving into return expectations, can you share a bit more about the assumptions that need to be true for a 3x in 5 years? Because we target 25% net IRR. So yeah, how do you look at this?
Yeah, so I started a bit with this earlier in the webinar, but usually how we would approach it is usually a management team will build their own management plan of what they think they will achieve over the coming 5 years. So we will try to look at that and kind of strip away, as I mentioned before, everything that could be essentially like non-core to what they're doing today. So if they think they'll be able to launch a new product, if they think they're going to acquire a company or go to a new geographical market, we're going to try to take those out of the model to only look at, the product you're selling today in the market you're selling it today. How much do we expect that you can scale that, conservatively? So not at the growth rates that the management team is assuming of usually like 200% plus, but more conservatively. We usually also take a lot of cuts to their cost assumptions. So take a cut on margins and the ability to get to profitability. And then based on the case that we've built, we'll look for both public comparable companies or other transactions that have happened in the space to see at what kind of multiple would a company exit in this industry. And that will lead to the return outlook that we have. And generally, our kind of base case should be above a 3x. We also receive, as I mentioned, the management plan, which, can be sometimes closer to the 100x or for sure the 20x plus because they're very ambitious management teams. And then we also get the case of our relationship GP that's investing in the round, which tends to be anywhere between let's say 5 to 10x. And then we have ours, which is a bit more conservative. And then we even create what we call a downside case, which is, in a case of very slow growth, where the company is not able to meet their cost targets or their, growth ambitions, perhaps in a market where like exits are tougher, what could happen there? Because a lot of our companies have a hardware or IP component, maybe even assets like a factory. There's usually some value that can be retrieved from the company. So our downside case looks at that scenario where we are able to recover some capital, sometimes all of our capital, but not really make a return. So we want to see what is kind of the worst case as well. And that's the full, I would say, underwriting picture that we look at.
And with so many funds in your network, do you also talk to funds that have passed on a deal then? And do they give information on the deal or like also financial information?
Yeah, for sure. That's very important as well in our process to do these reference calls. So we're not only going to speak to our relationship GP who is in the board and they've been an investor for years and they love the company and they're excited about it. That's a very helpful perspective for sure. But we need to speak to other investors in our network that have looked at the company, passed on the rounds, and understand why. So that's definitely a part of our process.
Cool. That's good. And then maybe looking also at the downside a bit more, what would need to go wrong for us to not achieve our target returns?
Yeah, it's a great question. I think when we look at the downside, um, tends to be a couple of things. So either the company is simply not able to execute on their plan, it is too ambitious, and they are only able to achieve slower growth. For some companies, not the majority that we look at, but for some, there will be fundraising risk. Most of the companies we tend to look at, we're investing in their last rounds of equity financing before they can become profitable and access the debt markets. But for some companies, we know there will be around maybe even two of financing needed. And then you take fundraising risks because what happens if the company is not actually able to raise that capital? That means, that's the end of the story, or at least that it will be again slower growth. So we prefer not to take that risk, but that is something that could happen. And then the third, there's always more external factors that a company even cannot control. So if the company is, for instance, waiting for the IPO window in the public markets to open, it could mean that our exit is delayed beyond what we had forecasted in our base case. We like to underwrite to companies that can have both an IPO and a trade sale type of exit. But in some cases, the company founder maybe really set on a specific, IPO exit, and then there could be like timing delays due to market as well.
Maybe my last question on this, which exit route is the most probable for companies that we're co-investing in? Is it an IPO?
Um, I don't know, actually, it's a good question. I think we tend to really prefer to underwrite to a trade sale or a sale to private equity. For a company that has like more the characteristics of really high margin company that you could build a platform around that could be more suited to a private equity sale, or a trade sale where there's really a strategic angle in a specific industry. We prefer to underwrite to that because those um, the the returns you can underwrite in an IPO tend to be, a bit too out of what we prefer to do with our approach. But there are a lot of companies that will be IPO. Actually, several of the companies that we've invested in are going through IPO processes at the moment, or at least preparing for that. So we like that is always a possibility, but that we don't rely on it.
Right. Okay. Well, I think we covered quite a bit. If there's someone still with a question, then please raise it. And I think for the last part, we can also go a bit more into the current status of the fund and timing.
Yeah. Well, then Liz, let's flip things around and I'll ask you the questions because you're leading this fundraise for us. So maybe to start before we go into the fundraising process, could you take us through the terms of the fund?
Yeah, for sure. I'll put them on the screen because it's a bit easier to explain. You see the screen again, right? Cool. So the key terms of this fund is that we want to raise $50 million dollars with a hard cap of $100 million. We're currently actually very well on the way with a first close of more than 35 million within like 2 to 3 months. So we're really, really happy with that. And the portfolio, well, I think Caro elaborated more than enough on what we will focus on, but it will be 12 to 15 investments, and the investment period is 3 years. So in those first 3 years, we will call for 70% of the capital. Then we charge a management fee of 1 to 1.25%, dependent on your ticket size. So from 1 million euro tickets onwards, it's 1%, and below a million, it's 1.25. There will be a step down of 5 basis points per year after the investment period. Then if you want to still get into this fund before the 31st of March, there's a 10 basis point discount, which is quite material on your management fee because it counts for all the upcoming years, so until year 10. And there's a carried interest of 10%. So this is our performance fee. Then there's some additional fund expenses, and yeah, the target net return of the fund is 2.5x TVPI, which translates to more than 25% net IRR. We also invest ourselves in the fund, so the entire investment team, but also within Carbon Equity, we have an employee feeder. So everyone within Carbon Equity can invest in this fund. The GP commitment is really from the investment team. So they are also aligned on financial incentives. And there's a minimum ticket size of $250,000. So I think it's good to know that this is a dollar fund. So the capital calls will be in dollars. We have quite some investors that have a dollar account, but if you do not have a dollar bank account, then you have to see how you want to change the currency, or maybe get a dollar bank account. It's really easy as well. And then we have a quarterly capital call scheme where we expect to call 30% in the first year.
Great. Nice. Super clear. And then some questions that we actually also get very often is, I think some people don't understand what the difference in our terms. So in specifically like the management fee and carry that we charge versus a typical private equity fund. What does that difference actually mean in terms of the effect on returns?
We actually have a really nice slide on that. So the lower fee structure of our co-investment fund really leads to higher returns, because it has a really big difference on how much a fund can invest. So people often hear about lower fees and they think, oh, that's nice, paying 1% management fees instead of a 2% management fee. But what's really important to note is that you can just invest way more capital. So if you charge more management fees, you can invest a less bigger part of the fund. And because we charge lower management fees, we can, for example, for $100 million fund, we can invest 90 million instead of $80 million. And here you see the differences with regards to lowering the 2% management fee to a 1% management fee, and lowering the 20% carried interest to 10% carried interest, which bottom line has an impact of 0.41x on the total net return. So then your return would look like 2.53x instead of 2.12x. So that's quite a difference.
Wow. Yeah, really interesting. Cool. I assume we've gotten everybody very excited. So, in terms of the fundraising process, where does the fund currently stand, and how should any investors think about timing?
Yeah, so we currently have a little over $35 million committed, and I think we're getting close to the target of $50 million around summer. And then we'll probably use Q3 and maybe part of Q4 to go towards our hard cap. But it really depends a bit on, we have some bigger investors in the pipeline. If some of them will commit, then it could go faster suddenly. So yeah, our final close, I expect it to be around Q3, Q4, a bit dependent on how fast things are moving.
And with the upcoming close now, I think it's March 31st. Is there any incentive or reason that people would want to come into that close?
Yeah, so there's a 10 basis points management fee discount if you get into the close before 31st of March. If you would get in, then there would be a short, digital onboarding process. It's quite easily made, set up through our platform, where you just have to, upload some documents, do like a selfie and a passport photo, and then you will go through our onboarding, and then you will receive a subscription form, which you have to sign. And then after signing this subscription form, you will receive the first capital call of around 15 to 20% around mid-April. So that's always like 15 to 20 days after the close. So that's why mid-April you can expect to have to wire the funds if you would get in.
Okay, very clear. I think we've gotten a couple questions through the Q&A box and the chat. I see the first one in the Q&A box from Hans. He's asking, as the co-investment platform scales alongside the portfolio funds, I imagine the origination and monitoring workload grows significantly. Curious how you're looking at managing this. And he said actually with sufficient human capacity, which already points towards my answer. To be honest, I think ever since the launch of ChatGPT in end of 2022, we've been exploring like, is there a way to alleviate our workload on the monitoring side of things? Because indeed it is a lot of reading PDFs, extracting numbers, putting them in our Airtable database. And for a while, the PDF extraction capabilities of the AI tools were not very reliable. Sometimes there were still things being made up, and it was not very easy to structure this into like a digital flow. You still had to sometimes copy paste from ChatGPT into that database. And um, long story short of saying that in the last couple months, there's been a lot of developments. Actually, at Carbon Equity, we've moved towards using Claude as our primary AI tool. And with Claude Cowork, you can now build this way easier. So as speaking right now, I just had an update earlier today with our team where they reported that they're transitioning the structure of our Airtable database so that it can be automated with Claude, at least for the data entry. And then we'll have to iterate whether Claude can also like flag the companies that are very interesting, or if we will have to still have like a very strong human in the loop. But it is something we're exploring as we know that we're aware that the workload will only increase.
Yeah, and we have a reporting cadence, of course, of every quarter. So every quarter we're uploading this quarterly report. So that's with 30 funds that we now manage and 275 companies underlyingly, we get better and better at it. So also within our fund reporting and management team, there's a lot of steps that have been made.
Yeah. And then I saw a question from Bart in the chat of will we accept capital coming in from the US? So I think he refers to American investors.
Unfortunately, US investors, so with a US passport, it's quite hard to invest with us. However, if you have a Dutch or a European passport, it is possible to invest with us. But maybe for specific cases, we can also be in touch over email. But overall, yeah, people with US passports have not been able to invest with us because of tax reasons. The fund is just not tax optimized for US investors. That's why.
Yeah. I think those are all the questions we've received so far. We can hang along for an extra minute, but otherwise, Liz, I think we can also wrap up.
Yeah. Yeah, I think the time management. Oh, there's one comment from Bart. Yeah. Okay, let's discuss that part separately. But nice to see the interest and yeah, let's wrap up. See if there's any other questions still coming in. But I think to just summarize or recap what we've been discussing is that we in short, see a really compelling entry point in growth stage companies within the energy transition, and that we think we have quite good access through our GP relationships, the 30 GP relationships that we have. The fund has already begun with their first investment, which is Harbinger. And for investors considering participating before the 31st of March, we're happy to schedule a follow-up or I'm always available for a call or an email. So yeah, thank you for joining and happy to stay in touch.
Thanks, everyone. Have a great rest of your days.
Bye bye.
Bye.